Hello there, in this video I'm going to go through some high yield dividend stocks. I've got two monthly dividend stocks to go through, and I've got one super high yield stock which actually pays a yield of over 7%, almost 8% return. The reason I've been looking into this really is I'm looking to build myself a dividend investment portfolio so I can get an income, a passive income in fact, from dividends. The savings accounts at the moment are paying extremely low interest rates, so this is one of the things I'm looking to do with some of my surplus cash. Do remember, I'm not a financial advisor, so this is not financial advice. You need to do your own research. I'm just going to give a quick overview of some shares in this video here. It's up to you to decide if you want to invest or not. As again, I'm not a financial advisor, so this is not financial advice. It's just information about some of the shares that I've personally been researching. So if you're new to this channel, welcome. My name's Andy, and on this channel I talk about money and success. If you're interested in either of those two topics, please do consider hitting that subscribe button down below, hit the notification bell, and you get notified every time I post a video. If you find this video useful, please remember to give me a thumbs up. That helps the YouTube algorithm, and I really do appreciate that quite a lot. So thank you very much. Remember, it's important that you don't invest all of your money in stocks and shares, no matter how tempting the high yields might be. You should always have a proportion of your money set aside available in cash, and at the very least have an emergency fund of some sort. I have made a video about that. I'll put a link in the description to that video so that you can access that and have a look at that if you don't have an emergency fund or you don't know what an emergency fund is even. But with that said, let's move on. Okay, let's dive straight in. The very first dividend stock I'm going to talk about today is a REIT. In fact, all three of these dividend stocks are REITs, REIT being a real estate investment trust, meaning the underlying assets that the companies own are property. I'm a big fan of property. I'm a landlord myself. I own quite a lot of property, so I believe in property, so that's why I'm so interested in these. This first one, it actually bills itself as the monthly dividend company. It's paid consecutive dividends now for 26 years, monthly dividends for 26 years, and they've been growing consecutively for 26 years as well, which is phenomenal, meaning in the last crash, it didn't bother it at all. It kept paying and increasing, which is fab. The current yield on it is over 4%. We'll go through the details in a moment. And this particular dividend stock mostly invests in retail, standalone retail units, and also industrial units. So that's a little bit about this company. Let's have a little look at its website. So this first company is Realty Income. It bills itself as the monthly dividend company. As you can see on its front page here, it tells you that investors have had a compound average annual return of 14.6% since 1994, which is obviously fabulous. It's paid 598 consecutive monthly dividends. I'd like to draw your attention to this part here. It says about the company, the monthly dividend company is an S&P company dedicated to providing stockholders with a dependable monthly income. Our monthly dividends are supported by cash flow from our property portfolio. They are absolutely dedicated to giving monthly dividends. So if you're looking for an income that's monthly, this is a really good stock to consider, I think. If we're to look at its balance sheet, I can see here that it's got growing assets year on year, which is obviously fabulous. On the income statement, we can see that the revenue has again been growing year on year, which is good news. And if we scroll down, we will find the net income. And the net income there, as you can see, has been growing year on year as well. So that's a good sign. You've got a healthy, growing company. That's the Realty Income Corp. So here's my overview of the Realty Income Corporation. You can see that it's had a high, 52-week high of $84.92, a 52-week low of $38. So it crashed 55% when everything crashed, basically. It's currently 24.4% from that high, so there is room for it to grow back to where it was. So you have got the scope for some capital gain here as well, which is obviously nice, in addition to that healthy dividend, which is 4.36% and is paid monthly. If you are hoping to get that dividend to be a 5% yield, you'd need to be able to buy this stock for $56 per stock, per share, basically. So if the price dips $56 or lower and you buy it, you're going to get a 5% yield. That's obviously great. So that's where I'd really be looking to buy, is $56 per share or less, really. And that would be absolutely fab. Whether it's going to go down to that price again, who knows? It's currently $64.17 per share, and it's a share, it moves. Okay, so it pays a dividend yield monthly. The payout ratio is 84.38%. That's fine for a REIT. Real estate stocks always have a high payout ratio. If it was a regular stock, I'd be looking for a lower payout ratio than that. But for a REIT, I'm not worried about that at all. It's total assets to total liabilities. It's just one little thing I like to look at there, just really to make sure it's not going to go bust. That total assets liabilities ratio, I like that number there to be above 1. It's above 2, so that's absolutely great. That's a very healthy company there. So that is Realty Income Corp. Let's move on to number 2. Stock number 2 is STAG Industrial. They literally buy industrial units. That's what they specialize in, industrial units. So whereas Realty Corp, the last one, it was shops and some industrial. This one is industrial, so distribution warehouses. If you think of that kind of thing, that's what they buy. And on their website here, you can see in 2019, they acquired 69 more buildings, invested a further $1.2 billion. That's 16 million square feet. And if you look on here, it shows you quite happily what they've acquired over the years. So you can see it's a growing portfolio and they're purchasing more and more, which is good because that means they're going to have more and more assets kicking off more and more profit and able to pay your dividends, which are monthly. Monthly dividends again. We like this, right? Let's have a quick look at their overview here. So if we look at their share chart, you can see they've generally been increasing. So that's good. But again, they've had this dip. So they are still down from their highs. That shows, I would say, that they're going to be good value at the moment. Dividend overview there, you can see 4.96%, 8 years growth, and they've got a 78.25% payout. If we look at the financials on this one, we can see on the income statement, the income has been growing year on year, and it's actually almost doubled since 2015. Which is phenomenal. And the net profit or net income, which is basically the profit, has also increased. In fact, it was negative back in 2015, but now the profit is 3 times what it was back in 2016. That's really good news. And if we look at the balance sheet, we can see the assets have been increasing. And again, they've over doubled since 2015. So that's good news. And if we go to my little summary sheet I've made for STAG, it's an industrial REIT. Its 52-week high was 33.48. Its low was 17.54. It's currently 29.04. So it's not fallen quite as much as the previous one, but its dividend yield is better at 4.96%. That's almost 5% yield. So to get a 5% yield, you'd have to buy it for $28.80 per share. That's very plausible. It was within that range just yesterday. Its payout ratio is 78.25%, so you would say even a little bit safer than the previous one. However, it's only been growing its dividend for 8 years versus the other one's 26 years. But again, total assets versus total liabilities, nice and safe at 2.25. So now let's move on to the third and final one. This one is Omega. This particular one is Omega Healthcare Investors. This REIT invests mainly, I believe, in elderly care homes. That's what their main focus is, which is a growing market. If you're not aware of that, that is a growing market. It's a need, not a want. And they invest in the UK as well as America, mainly in America. They've got 55 sites in the UK and the rest are all in America. Let's have a little look at their website now. So as you can see, they've got 966 facilities in the UK. They've got, if we click on this, it will show us here 55 facilities, and they are basically care homes. That's what they do. Dividend yield is phenomenal on this one. The dividend yield on this one is actually over 7%, nearly 8%. And let's have a quick look at them. Now you can see their graph. They were quite high share price back in 1998. Something went really wrong around 2000 and their share price collapsed. And this can happen when you're investing in shares. You've got to bear that in mind. But ever since then, it has been gradually increasing and increasing. Had a bit of a dip after in 2016, basically. And then it went back up and now it's back down and back on the way up, it looks like. That's what the graph looks like on this one. Let's move on to its financials. So on the income statement here, you can see the general trend has been up. There has been a couple of dips. So it dipped down in 2018, but it is on the generally the revenue is going up. So let's look now at the net income, which you know I like to look at. And again, there's been a couple of dips, but the general trend is up. So it's not, I won't say as healthy as the previous two companies we've looked at. On the balance sheet, assets have been increasing. Let's have a look at total assets, please. Total assets. Yeah, again, they went down a little bit, but generally that's going up nicely. So not too bad at all. Here's my little overview for Omega Healthcare investors. You can see the 52-week high was 45.22, the 52-week low was 13.33. That was a 71% fall. It's currently 23.7% down from its high. Its yield, though, is 7.76%, so that's what really makes this one tempting. Almost 8% dividend yield. It's not paid monthly like the other ones, though. This one pays quarterly, so you get your dividends paid 4 times a year, whereas the previous two I showed you pay monthly. The assets versus liabilities, again, not quite as healthy as the others, as you can see. It's 1.73, which again, it's fine. There's nothing wrong with that. As long as that number's bigger than 1, it's got more assets than it's got liabilities, so it can cover its debt. So that's the key thing. That's fine. I'm not worried about that. Again, it's got the higher payout ratio than the others, but again, it's a REIT, so you expect high payout ratios with REITs. So that's nothing really I would say to worry about. But obviously, this is more likely to drop its dividend than the others. It's had dividend growth for 5 years, and that is that. Let me give you an overview of the 3 now. So the 3 side by side, as you can see, Realty Corp, ticker symbol O, gives the lowest interest rate, but probably your safest one. So it's the lowest return, but probably your safest one, and it pays monthly. STAG is also very, very safe and pays a higher interest rate, 4.96%. I actually really like STAG, having done this review today, this video. STAG for me is my favorite of these 3. And then we've obviously got Omega with ticker symbol OHI, which is the highest dividend yield of all at 7.76, but it's also got the highest payout rate and the shortest period of time of continuous dividend growth. I hope you found that useful. If you have, please do remember to subscribe. Please check out my other videos, and remember, only invest money that you can afford to lose. You should have some money set aside. If you have not got an emergency fund, please make sure you've got one set up. Thank you for watching, and goodbye.